Welcome to the What to Watch video update. This is a video that I do once a week where I pull out the charts that seem to be telling us something right now, and I put them into three categories: positive, negative, and then those things we're just keeping an eye on to see if they turn more positive or turn more negative. And we're dealing with a scenario right now that the market's trying to work through in that we're looking good from a bigger picture perspective with the S&P 500. The advanced decline line's doing great. The new highs, new lows are looking pretty good. But on the negative side, the stocks that really drive the market, the mega caps, the large cap growth, they continue to underperform. And that's what we've been seeing. Now, some of this goes back to last summer, last fall. It really started to develop after we set an all-time high in October. That was a strong, solid all-time high led by growth taking us up. And we've just been kind of floundering around ever since with the market turning more defensive. Now, at the same time, the economy's looking pretty good from a stock market perspective. And so some stocks that do well when the economy's doing well, they're seeing a lot of favor right now, and they're kind of taking the place of the large cap growth. And if that is the case, then we might be in for some more sideways moves over the next whatever period of time until the character of the market actually changes. But we are holding up, and that right now, that kind of looks like what's happening. But what we're also seeing is a setup for the market where the smart money comes in and they start to rotate from one part of the market to the other. And that's a more defensive shift. We've been seeing that now for the last few months. And that's usually what happens before the market gets ready to decline. So that's kind of where we're at right now. And the charts have been telling us this going back to last fall, this whole rotational thing going on. Now it's becoming a talking point. I'm seeing it more in articles that I run across. There's probably more YouTube videos out there than this that are talking about that. And so it'll probably get dealt with here pretty soon. And then the market will probably do something completely different. You know, if everybody's gearing up for it to go down, it may continue to go up. If they're gearing for it to go up, then it may go down. In the meantime, we might be in for a lot of continued sideways chop. Now, from a seasonal perspective, we're in a midterm election year. We're coming up, we're finished with the first part of February, and we're coming into the second part of February, which tends to be kind of a weak time. Now, we had a weak period coming into January, right after the Martin Luther King Jr. weekend holiday. Didn't really do all that much. So that kind of pushed things out. It's like, okay, let's look after President's Day and see what happens there. And so there's a lot of things that we're keeping an eye on just to see, okay, what kind of a scenario is going to win out here? There's a lot of geopolitical things going on, not really having a direct impact right now, but that could change at any time. You've got the US and Iran, you've got Israel involved. There's this whole Venezuela, which has kind of drifted out of the news lately. And of course, Greenland, which like nobody's talking about now, that was like so 2 weeks ago. And these things come and go, and we don't know what's going to come next. We're keeping an eye on Cuba right now. I'll go through this in a moment. I posted a couple of articles because I've been trying to find out information as well. There's some things going on, and I'll talk about that here in just a moment. Okay, so this is being prepared for Monday. Oh my goodness. It should be Tuesday, March 17th. That is obviously a typo there. Okay, first, before I get into this, I do have a program. I'll try to be quick going through this. This is the full blown program. Now, it is $97 a month, but I'm not charging anything right now. If you sign up for the full blown program, you're comped for right now. I'm an educator. I'm not a promoter. I'm not out there wheeling and dealing trying to get folks involved in some kind of a program. I want folks to experience what I have to offer as an educator and going into my fourth decade of being involved in the markets overall. And I've learned a lot of stuff, and a lot of this could really benefit a lot of people. And so I have a full-blown program that I've completely developed myself. There are daily videos, weekly videos. I have courses. You can set up times to talk to me. I have newsletters, I have podcasts, all of that. Once it finally gets up and going, it'll be $97 a month. And here's the link below, right down here. But I also will put this below the video on YouTube and Rumble. Now, if you don't want the full-blown program, but you want immediate access to the videos, because that's the way they're designed, is to be viewed as soon as they're available, and I try to make them available. I really I take that very seriously to post them as quickly as possible, and they're meant to be viewed before the market opens. And you like that. You want access to that. That's $19 a month there, but I'm currently not charging anything for that. And then there is the free access. Now, I used to post these on YouTube and Rumble. Stopped doing that because I was saturating the YouTube and Rumble channel. And it's like I have a whole lot of videos out there, but they're not getting spread out so much. It's kind of screwing with the YouTube algorithm. And I don't know what kind of algorithm they use on Rumble. But if you want to have delayed access to the videos, now they're available right when the market closes. The videos that are immediately available, that's before the market opens. And this information that I'm going through is time sensitive. It's still useful to a lot of people to watch it later as more of an educational tool. But if you want to implement the insight and commentary that I'm actually going through in the videos each day, they're best to be viewed before the market even opens, or at least I do a lot of things right at the close. I don't mess with the open. The amateurs open the market, the professionals close it. All of the strategies that I teach, we focus right on the close. And then we have the whole day that we can watch things unfold, and then we make our decision. And doing this for decades, I found that to be the most advantageous way of doing things. Okay, another thing is for $8 a month, again, it's free for right now. It is a newsletter where I take the transcript from all the videos that I do and I edit it in using AI. And then from there, I just create a newsletter. And this can be a good starting point for some folks because you can read this in just a couple of minutes. It's usually when I type it out, it's less than 2 pages. And so it's something that I try to just hit the facts. I'm not trying to really say all that much in there. Just kind of give a rundown. Okay, this is looking good. This is looking not very good. And then you read through this and you're like, okay, now I better go over and watch the full length video. Just, but at least, I put a lot of stuff out there. There's a lot of videos that I do, and I know people are busy. And some days it's you don't have to go through every video that I post. There are times when I wish I didn't have to do a video every day, but I've made a commitment to doing that, so I just go through with it. Once that gets up and going, it'll be $8 per month there. Now, I do have a free part, and there are a couple of articles that I posted that I'll go through in just a moment. I'm trying to make more use of that, but I'm waiting for more feedback from folks. Tell me what you want. Let me know what you want posted there. I don't do individual stocks, even though we analyze them, but how do they ultimately impact the S&P 500? I don't do crypto. I'm not into gold or silver or Forex or anything like that. I focus on the S&P 500. All right, and then I do have a daily podcast. Again, I was putting this on YouTube and Rumble, but I decided to just stick it on my website. It's free. And if you notice the link down here at the bottom, SPX video delayed, this is available right when I do the podcast. And that's usually, 6, 7 hours before the market opens that particular day. So it's well available before the market even opens. 4, 5, 6 minutes. I really try to limit that. And this, you can listen to it. It's audio only. And you just kind of get a quick rundown. And then from there, maybe jump over to the newsletter. And okay, well, maybe now I'll jump over and watch the video. That's what I'm trying to do. Because since I put so much stuff out there, I realize I'm a realist and that people can't watch this every day. They don't have time. They're doing other things. Well, you can listen to the podcast, read through the newsletter, and then determine, okay, I'm done with the stock market for today. Now I'll go and do my job and be with my family, do whatever you have to do. But this just kind of gives you an idea of, okay, this is where we're at with things. And then you can determine if you need to go to the next step and actually do some more research yourself. Okay, then here's some articles. And now what I do, I'm constantly asking questions. You'll find in my videos, I'm not very dogmatic. I don't really express opinions all that much because they don't matter. And that's why my videos don't get as many hits. I'm not a a doom and gloomer. I'm not using thumbnails to try to scare people into watching my stuff. I don't believe in that. I'm an educator, and I try to come from that from a peer angle using critical thinking, not emotional trickery, is what I really see it as. And that's all advertising really is. Well, when I'm trying to find out information about things, because they're always changing and I'm always learning new things all the time, that's what makes us so exciting. Now with AI, it's a lot easier to find information. And I posted two articles in the past week. Another buzzword that we're starting to hear is AI disruption. What's AI going to do to the employment force? What's it going to do to the economy? What's it going to do? And everybody has an opinion, but nobody knows what's really going to happen. And I did this and posted this article as of, I think it was Wednesday or Thursday this past week. I'll keep up on that, and then we'll just see. Okay, uh, you've had these things invented over the decades. The the smartphone, and then we had TV that came in and was supposed to wipe out movies. We've had all these things that were supposed to just destroy life. Well, human beings are really good at adjusting and changing direction and modifying things as needed. And they talked about that with calculators and, all these things that have come. We're going through that right now with AI, and they're just calling it the AI disruption. There are times when the AI stocks are doing really well. Lately, they've been a bit under pressure, and that's what gets blamed when we're really going down. And that's what's sucking a lot of the life out of the mega caps because they're heavily involved in AI. So it's not a very long article. I will update that as needed. I'm asking questions all the time. As I do that, I'll be posting more articles, and it's free. They're free. You go to the full-blown website here. All you need is an email address, and it'll be in the free area, and you'll have access to that. I also posted another one because I was hearing bits and pieces here and there that Putin in Russia, he's like, well, maybe we ought to start settling things in the US dollar again. Well, that goes totally against what he's been trying to do for decades now is wipe out the US dollar and stop using it as much. So it's like, okay, this is something different. I found a few different sources on that. I used AI to generate an article and I posted that there. And I'll keep an eye on that. One article that I plan on doing some research on, but I haven't done it yet and posted it is what's going on with Cuba. That, we've had Venezuela, we've got Greenland. Of course, we're in this kind of ongoing fight with Canada. And a lot of these things that are happening in Panama Canal and a lot in the Western Hemisphere, which it goes back to the Monroe Doctrine, which is what, our fifth president of the United States, I believe, very early on, who said we don't want to control the Western Hemisphere, but we don't want things going against our own interests in the Western Hemisphere either. And that you can make a case that that's kind of what's going on here. Now they call it the Monroe Doctrine, after Donald Trump and everything. Of course, if he's doing it, it must be evil. But if another president was doing it, they might just be rolling out the red carpet for him, talking how wonderful it is. So, then there's all that stuff going on in the world these days as well. So I'll be posting more articles there, kind of on an as needed basis. I don't put them up every day. There might be times when I put two or three at one time, and then I might go a week or two and not put anything up there. It's more as needed. Okay, so let's go through it. Now I have the date right on this one here. Tuesday, February 17th, the positive things. Now, every week we get this survey from Investors Intelligence, and all the people out there that make recommendations, buy this, sell that, blah, blah, blah. Well, we're getting a very high reading here, meaning that they're very bullish on the market. And a week ago when I did this video, we were up over 4, and that's a really high reading. And sometimes that can actually mark a top in the market. Well, we fell down a little bit here. We're at 3.87, but this is still positive overall since it's above 3. If it continues to fall, this will quickly go over to the negative side. So we just want to keep an eye on this. Yeah, we're positive here. Most of these folks that make recommendations are bullish, but they've kind of topped out their bullishness, and where do they go from here? And usually that can be down. Now, this is very, very positive. We set an all-time high with the advanced decline line for the S&P on Friday based on price. We're a little bit lagging here based on volume because it's not the really big stocks that are driving things right now. Volume has been lagging a little bit. based on some of the charts that we look at because it's the Microsofts and the Googles and the Nvidias and those, those are the ones that do a massive amounts of volume. They're not really doing all that much these days. And so investors are going into the rest of the S&P because there's 503 stocks that make up the S&P 500, and they're doing better here based on price, but there's not still as much volume here. But still, this is quite healthy overall. I have a moving average right here. We're well above that. So we're looking pretty good from that aspect. And then I have an indicator called the advanced decline oscillator. This looks at the advanced declines over the last 10 periods, so 2 weeks when we have full week trading weeks. And this is positive because it's zero, above zero, and it's been chopping higher here. And so this has been improving, kind of confirming what we're seeing in the advanced decline line. The new highs, new lows. Now we dropped off on Friday, but even when we had the down day on Thursday, look at this massive explosion of new highs because we ended up having a higher open that day. That lasted about 20 minutes and then we tanked for most of the rest of the day. And we're not seeing much in the way of new lows. So we look internally inside of the S&P. We're trying to go up with the 5-day moving average of the highs and lows. Now we're really going up here with the 10-day, and there's not really much to compare it to, but this is getting a little stretched right now. It can still go higher than where it's at, but this might mean that it's getting a little overextended to the upside. But again, it could still go up even more from where it's at right now. Now we have the S&P McClellan oscillator indicator that's been around for decades, going back to the 60s. We're above zero and going up. Now, we're not seeing a lot of conviction here. It's just a lot of choppiness. Throughout December, we dropped down a little bit here at the end of December, and then we've come back up. So there's not a lot of real movement up or down. We're just kind of chopping around right now, but it's treated as positive because we're above zero. And then that feeds into this next chart where the summation index, this is longer term based on what the McClellan oscillator is. And we're going up based on price, but we're declining based on volume. We want these to confirm each other. So yeah, it's positive based on price, and that's the ultimate indicator. We have to follow price, no matter what volume's doing. But volume gives us the intensity of a move, and we're seeing a bit of a negative divergence with this chart. Yeah, then we look at the broader market, NYC McClellan oscillator. We actually dropped below zero on Thursday. We were able to get back above it. Still not an awful lot of conviction here, but the NYSE is actually holding up better right now than the S&P 500. And then this feeds into the summation index here, where we're starting to go back up with the summation index based on price and actually ticking down just a little bit here based on volume. But it's really hard to see when there's these really small moves here. I'm treating this as positive mainly based on price right now. Now we're still holding out above the 100 period moving averages. That's where we hit back earlier in February and we closed right there and then came back up off of that. Right now, we came right down to the 100-day moving average, a little bit above it on Thursday, and we've closed a little bit above it on Friday here. So this is a support level that's holding. You'll notice there's also an S1 pivot point here. I rely heavily on pivot points, and they're very influential, especially when we get to the NASDAQ and NASDAQ 100. But that you see where the moving average and this S1 level are converging with each other. That's kind of like double support. So are we going to be able to come up from that? That would be positive, of course. But if we break through this, that's going to turn things quite a bit more negative. But for right now, since we're above the 100 period moving average, we're treating this as positive. Now you'll see other moving averages that are negative. Then we have this crazy thing here called the Ichimoku cloud, which really all this is a set of moving averages based on current price, and then they shift it forward. And this is used heavily in Forex trading. I use it here just as a chart that I look at every day. And we've been going a lot of sideways action here, but we're still holding up above the cloud. That's why this is positive. This is another support level, a little bit less defined here. As long as we stay in the cloud, that means support is holding. But you can see these lines here, these measure, the green is short term, the blue is intermediate term, the red is long term. We're flatlining as the market has been flatlining too. But I'm treating this as positive now because we're still in the cloud. And we bounced up enough. We were actually looking pretty negative after Thursday. The bullish percent index, which is based around point and figure charts, different than moving averages, different than oscillators. That's why I like this one. And we came up enough here. And if you look at the value here and you look at the value of the 5-period moving average, the value of the BPI closing is a little bit higher than the moving average. So this is switched back to positive. Unfortunately, when we get to some other charts, and the NYSE and the NASDAQ 100, those charts are negative. But the NASDAQ 100 is improving. But I'll get to there. And now I haven't been really showing a lot of different advanced decline line studies, but they've been holding up. This is a cumulative advanced decline line based on price, just coming off of all-time highs. A little bit of a lag here when we look at the cumulative based on volume, but still looking quite positive overall. Now, this is still positive. When we get to the daily chart, that's going to be on the negative side. This is a very long-term oscillator called the special K, like the cereal. And even though we're rolling over a little bit here, we're still well above this red line. So this is still treated as positive. The weekly parabolic SAR chart, we have a dot underneath, that is still positive. And this is another crazy thing. On the weekly point and figure chart, we saw enough of an upward move here to draw in three new X's. Now, when we get to the daily side, you're going to see red O's. That's how mixed up the market is right now. But because we saw an advance here, there's no signal that's being generated. But we saw enough of an upward move here to draw in those green X's, and that's treated as positive. And then the advanced decline line, looking at it in a little different way across different indexes, NYC common stock, S&P mid caps, small caps, holding up above this moving average, and the moving averages are going up as well. That's positive. And then we look at the NYSE advanced decline line here, just setting a new all-time high, just in Friday's session. And then when we break it out just based on common stock, almost back to a new all-time high, lagging just a little bit here on volume, but still, again, looking pretty solid overall. Now, this is an apples to oranges comparison, and I rarely show it in this video. I show it in another video that I do called the deep dive video. This is the apples would be S&P 500, the oranges would be the NYSE advanced decline line. The S&P has its own advanced decline line, but what I try to do with this particular study is compare the S&P with the broader NYSE advanced decline line. And we're seeing a bit of again, you could treat this as negative, but I'm treating it as positive for right now. Where we're really holding up well with the red line, that's the NYSE advanced decline line, where we were actually down on the week here with the S&P 500. So yeah, I could have thrown this over on the negative side just as easily. The Dow, even though it didn't have all that great of a week, it's still above its 50-day moving average, just coming off of being above 50,000 and setting all-time highs there for a while. So it's still positive, even though it's showing some weakness. Now, this is the second level of QQQ stocks. We have the NASDAQ 100. Well, this would be the NASDAQ 200 to 300. And they call it the next gen 100. And there's a lot of AI stocks in this second group here. The reason this is positive, we lost the 50-period moving average, but in Friday's session, we came right back up to it. So this is actually holding, and this is holding up a little bit better than the NASDAQ and NASDAQ 100 right now. We're below the 50-period moving averages with the index, and so this is a little bit more positive because it's right at its 50-day moving average. Small caps. Now, even though they didn't have all that great of a week and they're not back to an all-time high, we're holding up above the 50-day moving average. They came up to this R1 pivot point, kind of stalled out there, coming back down, but then they had a pretty good day on Friday. So I'm treating this as positive. This is another small cap index, the Russell 2000. The takeaway from this is we came down to the 50-period moving average right at the end of 2025, and we went up from there. Then we came down to the 50-period moving average again in February, and we've been up from there. We're still above the 50-period moving average now. Not showing an awful lot of strength, but we're not breaking below this 50-period moving average and turning even more negative. Small caps are now outperforming the S&P 500, and so we're going up here. We're actually seeing an uptrend with this ratio. And then small caps to large caps, we're also in an uptrend here, and small caps have been outperforming for the most part lately. Mid caps, one of the weakest areas at 2025, they would come in last place out of the 6 different indexes that I study. But they're holding up above their 50-day moving average. We closed right a little bit above this R1 pivot point. So they're holding up for right now. Semiconductors, that's pretty much what's keeping the large caps together and the mega caps together. Not showing an awful lot of strength right now, but not showing an awful lot of weakness either. And we're still above the 50-day moving average, even though this was down almost 1% on Friday. This is the Dow Jones Semiconductor Index. This is a weekly chart of the Dow Jones Semiconductor Index, and we're dropping a little bit below the 100% level with the 200-period moving average. And now this is positive. It hasn't proven itself negative to us. But a lot of times when we get above this blue dash line, this is where more significant declines happen. It could turn negative, but we don't, I don't try to forecast these things. We just look at where they're at right now, even though it's been coming down a little bit lately. Then we have another SMH semiconductor ETF just coming off of recent all-time highs, well above its 50-day moving average, and it was actually up on Friday. But then we have another weekly chart here, and we're still just a little bit above that 100% level with the 200 period moving average on the weekly chart. This is also not always, because some we've had a lot of false starts here where it looks like, okay, we're getting extended and we're going to start to go down and then we go sideways. Or lately in 2025 and 2026, this has been holding up quite well so far. And so we're just kind of keeping an eye on this, but it really hasn't triggered anything for the most part. Then we look at the semi to tech ratio, and it's just going to the moon. Now we want to watch this because if this reverses and really starts to tank, that's it's probably going to take the market down with it. Semis are a huge part of tech. Tech is the biggest part of growth. And we've already been having trouble with tech. That's really why a lot of this ratio is going up because semis, it's they've been doing okay. The charts I just showed you prove that. But it's that tech has been underperforming, and that's causing this ratio to really almost go parabolic here. At some point, the party may end, and this may actually start to turn and come down. Hasn't yet. We've been watching this for quite a while, but we just want to keep an eye on this. And then this software just getting hammered now. Semis, which are AI driven, it's like software. Do we need all these programmers? We have AI that can design our apps for us now. That's one of the concerns that's going on. And so software has been a weaker area. Semis have been holding up, and we're also seeing another parabolic climb here when here's up at the top is the Dow Jones Semiconductor Index, and this just shows how the semis are outperforming. Now, the correlation is not really strong between the two. We spend a lot of time where semis and software, when this is a very high reading, that means they're going in the same direction at the same time. Well, we saw a real drop off here as we got into 2026, and that means they're going in opposite directions, something that doesn't happen very often. Now we're improving here, but we haven't come all the way back up to giving a very high correlation yet. That's why we're watching this. And then the NASDAQ 100 to Dow, that's another growth to value. Now we're getting hit here a bit because the NASDAQ 100 has been underperforming. I'm treating this as positive because we're still above the red line. We keep coming down, we drop below that red line, it's going to turn this chart negative. And then the Qs, NASDAQ 100 to small caps, also showing some weakness here, but still above this blue line. If it falls below that, that will turn this chart negative. Semiconductors to Dow. Now, this has been holding up because semis have been holding up. The Dow's been holding up for the most part. And so this ratio is still looking pretty good. And then we look at a stock to bond ratio. Now, we're seeing some weakness coming in here. We're going a little deeper into the rainbow. But typically, when we're moving up, that means the market's expecting a soft landing, which means no recession. And yeah, we've had some weakness and then we recover and come out of that. And now is it going to happen this time too? Are we going to be able to bounce up or are we going to see more weakness coming in here? That's what we'll be watching for. And then we look at an inverse of that same thing. This just shows how bonds have been underperforming, but lately they've been outperforming. In Thursday and Friday session, we saw interest rates really drop, and that on the 10-year anyway. And that was more of a flight to safety. That's a little bit different because Thursday's action, everything got hit, growth and value. Pretty much everything was down in Thursday's session. And that's not only because there are times when we have down days, but it's just rotation. It's money going from one part of the market to another part of the market, but it's staying in the stock market. What we saw on Thursday and a bit of a carryover on Friday is we're seeing money coming out of the stock market and into the bond market. And that's more of a defensive move because bonds are considered to be safer than stocks. Now we have the negative side here with the date actually correct. We had a down week. And now we started off okay, but then we had Wednesday. This is when the employment report came out, and it was a lot stronger than expected. And the futures were positive. We had a positive open, but we set the high right at the open. And we never saw that price again. And then after that, the market was open for a little bit. We tanked. Now we were able to, it happened earlier in the day, so we were able to come back and repair this. But then this dark blue line, it was on the chart before the market even opened. That's called the daily pivot. and we were never able to really get above that. Then on Thursday, again, we had another gap higher open, and we set the high not the first 10 minutes, but the second 10 minutes. Each one of these bars is 10 minutes. You see 10-minute intraday chart. And then we kind of hung out around the daily pivot again and then just tanked. Well, we didn't see much of a recovery here. We tried to build a base, but it really just wasn't happening. And then this is why I focus on the close. And we saw some late day selling here, and that really took things down. Now, then on Friday, we had CPI, which was taken as market friendly. We ended up having a little bit of a lower open, but you can see the tug of war going on back and forth, not a lot of gyration. Finally, we tried to break to the upside, but we hit the daily pivot. Again, we stalled out right there, saw some more late day selling. We bounced up a little bit going into the close to be barely positive in Friday's session, but we were negative on the week. And the daily chart, since we're negative and we're below the 50 period moving average, that's why this is treated as negative. And these dashed lines that you see, these are previous pivot points. And we already have the pivot points for March that are on the chart. That's one cool thing about these. It makes the chart a little hard to read here, but we can see these well ahead of time right now. And then we were pretty much above average most days the past week. Now, sentiment, which was starting to improve, we were actually climbing above 50, which is neutral. Well, Thursday took us back down, and we really didn't see much of an improvement on Friday. So we tend to go with the direction of this, but it's been so choppy. This was going up into the high that we set in October. And you can see it's not all straight here, but it was moving up. There was some conviction behind this. Then we get into 2026 and we're just up, down, up, down, up, down. It's like a roller coaster. And then this is another sentiment gauge. It's called the ulcer index. So when it's going up, you're probably freaking out and getting an ulcer here. This was mainly designed for mutual funds because they only have one closing price after the market closes. It's called the NAV, net asset value. We've been pretty tame here for the most part. I also plot a moving average on here, and when I start focusing on this chart is when the ulcer index starts to climb above the moving average, and that's what's happening right now. I usually don't show these charts either. This is the equity put call ratio. There's logic behind the equity put call ratio, but it doesn't always tell us what we're hoping it will tell us. Because when this is going up, that means more puts, which get more valuable as something goes down. They're being purchased more than calls, which gain their value if something goes up. And so puts are heavily used. I use them in my program as a form of hedging. So we're trying to remove as much emotion as possible from everything. Well, back here in late 2025 into early 2026, we had a very low reading here. This is a 5 day moving average. I don't pay as much attention to the daily chart. I show it in every daily video, but it can be really spastic. And so we're trying to treat this. Okay, what's the general trend? And I use a 5 day chart here, and we were getting a very low reading. And when we get these low readings, you can see below this red line, sometimes that can mark some kind of a shift in the market. It may not happen right away, but this is a bit of a concern with this going up with the 5 day chart. Then we take 2 weeks and make a 10 day moving average here. That's continuing to go up as well after getting a very low reading, meaning the market may have been topping at that point. We haven't really seen much action. I mean, it looks like a big M here. If you're into McDonald's, that's kind of the price action that we've seen, the golden arches here. Now, this is a long-term chart, and I usually don't show this one in this video either. This is a 253 period moving average of the equity put call ratio. Okay, what use could that be? There's roughly, I know it's 248, sometimes there's 220, whatever, but this seems to be pretty good. This is like measuring, it's like a 1 year moving average here on a daily chart. Now, when this is going down, that usually means the S&P is going up. And then, of course, we had the freak out last spring. But you notice this thing just barely slowed down. And I was watching this last spring, and this was giving us some hope. Well, since that time, this has been starting to drift higher. We're not seeing it played out yet in price of the S&P 500, but when this is going up, you can see when this is going up here, we're usually going down. This is the bear market of 2022, and this thing was really screaming to the upside. We're not seeing any follow through on price, but the equity put call ratio longer term is telling us, okay, there's something not right in Denmark right now. Then we're above 20 with the VIX. When we get above 20, that's when we see negative annualized returns. We closed above it on 20. We remain above it as of Friday's close. And that can be more negative here. And I have a line chart, which is just the closing value, and then I have a bar chart, which is the open, high, low, close, and the momentum for the VIX. Now, I don't show this all that often either. It's like, yeah, I can see it's going up. I can see it's going down. But notice what was happening at the end of 2025. We were getting very low readings, well below the 14 level. That's a real positive environment, almost complacent. That's quite positive there. Well, notice how we've been hanging in there fairly well with the S&P, but notice how this has been drifting up and then we spiked and came back down. But for the most part, this has been drifting higher. Why would this be going up if the market's really positive? This usually goes down when the market is positive. And the fact that the momentum is measured by the MACD, that's going up. We can see by just looking at the chart, that's been going up, and now we're above 20. So this was like something that had been building for a while that kind of goes under the radar. That's why I have this chart. And I was trying to point this out in other videos that I do, but I thought, okay, maybe I should show it in this particular video as well. This is another way of looking at the VIX. This is a 3 month average of the VIX. That's longer term compared to the VIX, the daily version here. And this is a daily chart. And what's interesting is if you go back and see when we spiked above this green line, it didn't always mean a decline, but sometimes it meant things got pretty crazy there for a while. We hit this right at the end of 2025 going into 2026, and we've been pretty much coming down ever since. Even though we haven't seen really much of a play out here with price. We've got the golden arches M here that's been going on, and this is negative on the daily side. Now, to give it a little bit bigger picture context, this is that same ratio, but looking at a weekly chart. And look at times when this spiked and then what happened after that. Sometimes it was a non-event, but it seems like the higher we go, especially above this red line, if we get all the way up to the blue line, that can be pretty intense. But this happened at the end of 2025, early 2026, and we really haven't seen much follow through to this point. And we might not see any follow through. But this continues to drop. That's negative. And so we just want to be aware of this. And then we have an intraday chart of growth to value. This is negative. The blue line is growth, and it's just going down. The red line is value. That's not what you see in a strong market. We see the blue line above the red line, and we see, if anything, we see them both going up, but the blue line's usually outperforming. The blue line's going down. The red line's holding up a little bit better here, and that's more of a defensive market that's happening intraday. Then we have a 10-minute chart of it. This is the most important one, I think, because it applies to the S&P 500. You see how the growth to value ratio is just declining? And we even had an update kind of on Friday, and this is continuing to go down. We're below the moving averages. When this market is strong, we see this really just screaming to the upside. The fact that this is declining, that concerns us. And then here's an end of day chart with the S&P growth to value ratio. We're under the moving averages. We're in a downtrend. And at best, we're just kind of chopping along sideways. This is what we saw coming out of the lows last spring. That's solid movement here. And then we topped out and we've been just kind of underperforming ever since. And this is another growth to value ratio here. Below the rainbow and declining. That's negative. Large cap growth starting to fall below the 200-day moving average. We came down, we tested it, we bounced up. Now we're starting to fall below it. Now we can get that back, but if this continues to fall, that's going to be even more negative for the market. Small caps, which have been doing okay here with their growth to value ratio, not right now. Not looking all that good. Mid cap growth to value just looked atrocious here. Really, really weak. And then we have a number of different growth to value ratios. And if you look at all these, they're not looking positive. And we look at the large caps, mid caps, small caps, not looking really positive, all below declining moving averages. And then I have some other growth to value ratios that I've been pointing out now for a while. See how the S&P's been kind of drifting higher? The growth to value ratio here has been going down. That's a negative divergence. And I don't just look at one chart. I look at everything I can and say, okay, are all these charts telling us the same thing? Here's another growth to value ratio, underperforming, just like the one we just saw. Another growth to value ratio, underperforming. Another growth to value ratio. Now, this had been holding up better. Now it's starting to not look so good over here. And then we look at staples, which are defensive, to tech, which is growth. And we've been chopping around, but now see how we're breaking out? That means staples are outperforming the tech sector. That's a defensive move for the market. When this ratio is going down, that's when the market's really going up, and that's showing more growth. That means tech is leading. When this ratio is going up now, that means staples are leading. Toilet paper and toothpaste are leading high tech. All right, and then we compare that same thing, staples to the S&P benchmark index itself. See how this is just going up with a vengeance right now? That's more negative for the market. And then we look at the QQQs, which is growth, and then the S&P, which is growth and value. And we see how the S&P has been holding up, but look at how this ratio has been really underperforming. Now, we're not showing a real strong correlation when we look at the S&P and the QQQ to SPY ratio, but we spend a lot of time up in this blue area. We're not there now. We were trying to improve a little bit. Now we drop back down. It's trying to come back up, but that just means there's a general shift going on in the market. We're either rotating to stocks that are going to hold up better, but we're not going to see this explosive moves with the S&P 500 index, or the market's setting itself up for a decline. And we look at discretionary to staples. This is intraday. Not looking good here. Really underperforming when we compare it to a 10-minute intraday chart of the S&P itself. And then here, and look at staples just screaming to the upside here. Discretionary is just kind of hanging out here, a little bit of a decline. And so when that happens, this ratio goes down. This means staples are outperforming discretionary, even though this is an equal weight index. Another look here, discretionary to staples, holding up with the S&P, negative divergence with this ratio. And then we look at value to tech, which when this is going up, that means value is outperforming tech. Where for a long time, tech was outperforming value, and that's when the ratio goes down. When it goes up, that's more negative. And we look at this is one I've been watching for quite a while because this told us what was happening at the end of 2021. We were rolling over here and really starting to go down. This is SPY to staples. Now, this was the whole tariff thing, and that was kind of its own crazy little thing here. This has been developing a little bit more, and we're starting to drop below the rainbow. Some of the lines in the rainbow are starting to roll over, a little bit similar to what we saw in 2021. And since we're falling below the rainbow, that's being treated now as more positive. For the last couple of times I did this video, yeah, we were seeing some weakness, but we were still in the rainbow, and I was keeping it more positive. Now this is looking more negative. And then I have three smart money indicators, and they're all negative now. Accumulation distribution, because we try to figure out what's the smart money doing, and we just do the same thing. And since they're so big and they have so much volume, we can pick out what they're doing. Well, this is one of those indicators. Well, longer term, we're dropping below the red line. That's negative longer term. Then I have a boom indicator, which is shorter term, which is a momentum oscillator. It's just a MACD. And this is it's below its moving average. And so short term, long term, they are both negative. Smart money indicator number two. Although we improved a bit on Friday, this is the Chaikin money flow. The red line is continuing to go down. That's still negative. And we have the Chaikin oscillator, which continues to decline. It didn't bounce on Friday, and it's below its moving average. So all three smart money indicators are negative. Now, we were positive until a couple days ago. Now the vortex has turned negative with the red line crossing above the green line. That's negative. And we're negative no matter how we look at the trend right now. This is short term. Now we are showing a move up with the ADX. That's the dark black line that you see here. When it moves above the moving average and it's advancing, that shows a short term strengthening trend. And then how to determine positive or negative? Well, the red line is negative, the green line is positive, and the red line's above the green line. So this is a negative short term trend. Seeing that same thing here in the intermediate term, longer term here. Red line above the green, we're moving above the moving average. Now, long term, this is a weekly chart of the trend. We're still going down with the ADX, so we're not trending. And you can see the last number of bars, weekly bars here, we've just been on a long-term treadmill. But we're negative, even though the red line came down, the green line is going down even more. And so we're negative with this chart as well. But the ADX is just continuing to drop off, showing no trend. And then we have a thing called the Swindle Trading Oscillator. We're declining based on price and volume. That's negative. Then our momentum oscillator is really having a difficult time. We were going up with the S&P, and you see the negative divergence here. We were making lower highs with the PMO, the price momentum oscillator, and now it's below its moving average and declining. But there's a positive side to this. When we break it out based on price and volume, we're above the moving average and going up. We're lagging a bit here based on volume and we're rolling over a bit, but we're still above the moving average. These are the rest of the stock because this study here are all of the stocks in the S&P 500. And so volume is lagging, but price is still holding up fairly well. And then there's some additional studies here. All the stocks in the S&P, what are the percent of those stocks going up? We're above 50 here and bounced a little bit, even though we saw some weakness. We're trying to turn back up when we're above 50 here with the buy signals that are being generated. And we're drifting a little bit higher here with the PMOs inside the S&P that are above zero. But our momentum oscillators, they were improving, but you can see the top two, those are short-term oscillators. They're rolling over negative. Then I have three intermediate term oscillators. They're declining. And the long-term oscillators never did turn positive, and they're continuing to drift lower as well. So momentum here is clearly negative on the daily side. And just so you know, we're negative on the weekly side, but I don't show that chart in this video. This is another momentum oscillator that's declining called the choppy curve. And now the daily parabolic SAR chart, it switched to negative. A dot is on top. Remember back on the positive side, the weekly chart still has dots underneath. That's positive. When a dot is now on top, that has switched this over to negative again. So and I consider this to be a primary indicator. And this could end up being something rather negative. And now here's the NYSE bullish percent index. Gave us very high readings here, and then we started to pull back from that. We were bouncing up. Now we're continuing to decline. Now it's still technically positive since we're above 50, but the context is that this has been declining. Now the context here is actually positive with the Nasdaq 100 bullish percent index because we've been going back up. The reason why this is negative is we're still below 50, but you could also treat this as a positive chart since it's improving. And now this is the daily point and figure chart where the weekly chart was positive. The daily chart, we had enough of a decline to draw in three red zeros. So we're seeing positive signals and negative signals on the daily and weekly charts. We like those to confirm each other. Right now, they're contradicting each other. And then these are some short-term moving averages. It's called the bow tie. It's a 10, 20, and 30 period moving average. We, we haven't actually rolled over negative yet, but price is below all three lines, and you see how the lines are coming close to each other. So this is turning more negative, but not full-blown negative yet. We're seeing some vulnerability with the short-term trend. These are double and triple exponential moving averages based on 20 periods. They move too fast for my taste. So, but I use them to evaluate the short-term trend that I base on 20 periods. We're below both lines, and the green line and the blue line are starting to roll over. That's negative. And we're not looking as bad, but we're still looking more negative here with the 50 period moving average study. And we're below both of the lines. The blue line and the red line are just starting to roll over. And if that continues, this is going to continue to go down. Now, we could get that back as we're going through this golden arches M here. And then we did lose some short-term support with the anchored weighted moving averages. This was a maroon one. We lost that. And then blue, that's a little bit longer term. That's going back to the low set in November that we bounced up out of. We're below that. Now there's another low here, this orange line. That was set up when we set a low back in August. That's still above current price. And then here's another one that we set up here when we had a gap up. So there's a lot of support underneath the S&P right now. If we get down to here, is this orange line going to hold? Is this mustard colored line going to hold? It held back in November and we bounced up from that. So we'll see how that, but I'm treating this as negative because we're losing short-term support. But in the bigger picture, all these longer term, and these are the more effective ones, the longer the moving average is, the more influential it often is. And so you could treat this as positive in the bigger picture. I stuck it on the negative side because we're losing short-term support. And we're below the 20 period simple and exponential moving average. That's why the short term is negative. We're below the 50 period simple and exponential moving average. That's why the intermediate term is now negative. But remember back to the positive side, we're still holding out above the 100. And that's where we see it here. Below the 20, below the 50, still hanging out above the 100. Now, if we drop below that, we might end up going down to the 200-day moving averages. We don't know if that's even going to happen. The 100 held back in November. We came down, we got close to it early in February and came up from that. Now we're testing this area again. It's a little bit of a warning sign when we test an area and then come back not very long into the future and test it again. What we like to see is we come down here, test it, and then bounce up out of it. That shows the market's actually reversing. The fact that we're coming right back down to these levels relatively quickly, that could you could easily interpret that as more negative. This is the daily special K chart, and we're dropping below the red line. You remember the weekly chart is still positive. This chart is now turning negative. I don't show this except in this video, and there's a deep dive video that I show because we didn't get any signals in 2024. So it's like, why do I show this chart if it's not really generating anything? We're flipping over negative, and we crossed over positive back last summer, and now things are starting to show some more weakness here. Now, this is a weekly chart, and we're just going nowhere overall. We were down almost 1.4%. So that's why I have this on the negative side. Now, notice how we're having a difficult time getting above these dashed lines. These were longer term pivot points that the market, even though we're beyond that period of time, and this is a little above the 7,000 level with the S&P, we just cannot seem to get back up there, at least yet. And now this is another way of looking at this negative, where the bar chart, that's the weighted version of the S&P, that was down. The equal weight version of the S&P has been up. And so this just means that the broader S&P is participating more, and we're seeing a real lagging with the mega caps and large cap growth. And that's why the S&P itself is lagging. This is another way of measuring that with a ratio. When this is coming down, that means the S&P 500 weighted version is underperforming the equal weighted version. And here's where we're a little more negative. Now, the reason we're negative here with the NASDAQ is we're below the 50-period moving average. Now, we're coming down to this S2 support level. And I have found sometimes, not always, but most of the time, these pivot points are very important for the NASDAQ, and we're getting really close to it. And so far, we're holding out above it. That's about where we set the low on Friday. And so far, this support is holding. The reason why this is negative, again, is because we're below the 50-period moving average. Now, we're a little bit further away here with the NASDAQ 100, but this is getting close to that S2 support level. This is also negative because it's below its 50-day moving average. The momentum for the NASDAQ 100 is negative, and we're below shorter term moving averages with the QQQs. This is a 20 and a 50, and they're actually crossing over negative now, but we're still positive longer term since we're above this blue line, which is a 200-period moving average. There's a weekly chart. And you can just see by looking at this where we've been going along, drifting down a bit, but we're not falling apart, but we are not seeing any real strength now. We've had 3 down weeks in a row with the NASDAQ 100. And we lost the 50-period moving average with the broader market, Wilshire 5000. Now, we fell down below this last Thursday and then got it back on Friday with that powerful up day. We fell back down below it on Thursday this week, and we're still below it now. So is that a bit of a concern there? And then there's another broad market measure, the total US stock ETF. Same thing here. We're below the 50 and have not been able to get back above it. And then we look at the financials. My goodness, when we were doing better here, the financials were outperforming the S&P. And then they were holding up better as we were tanking last spring. And then I started to point this out way back last summer. It doesn't mean I have any insight. I was just saying, showing or talking about what I'm seeing in the chart. And we've been underperforming now. And we tried to improve there for a while, right at the end of 2025. Well, now we're back to not performing all that well. We haven't broken to new lows with this ratio, but it's certainly not showing any strength right now, and it's in a downtrend. Now, because keeping an eye on the financial areas of the market is very important. There's a popular ETF called ARK. You probably have heard of ARK, but they have a different ETF that most people get into. This is the FinTech Innovation ETF. It's financial and tech together. This is not looking very good. You look at this all by itself, and we're in a downtrend and declining here. It looks even worse when we do a ratio with the S&P. And this is just not looking very good right now for the financial sector. The FANG index dropping further below its 200-day moving average. We hold down here for a while, we might generate a death cross. These are all the stocks that make up the FANG index. So if this is not doing all that well, that means these stocks are not doing all that well, and these are the real drivers of the market. Now they're not falling apart. Maybe Microsoft, you could say that because they've just been getting hammered since they came out with earnings. But these are the stocks we need to really go up to drive the S&P 500 up, and they're not going up much right now. And we look at the ratio between the FANG index and the S&P 500, see how it's just been drifting. We go back into October. After we set that high, we've been underperforming ever since. And look at the negative divergence when we compare it to the S&P. And the correlation is fairly strong. We're up in this blue area because we've seen a little bit of weakness with the S&P, weakness with this ratio. So that's why we're ticking up just a little bit here. Nvidia, the darling stock, just continues to go nowhere. It's just hanging out around its 50-day moving average. And then we compare it. We look at Nvidia to the Nasdaq 100, not doing all that great, but not falling apart. Nvidia to the S&P 500, not doing great, but not falling apart. The Nvidia to the Dow Jones Semiconductor Index, seeing a little bit more weakness here. But again, it's not like this is falling off a cliff. If Nvidia really starts to tank, this ratio is really going to start to go down with more conviction. And then just to show, you remember when I looked at the S&P 500 and we're kind of hanging out closer to the top end of the rainbow, and so the market's not anticipating a recession. This has been consistently underperforming, and we're deeper into the rainbow when we look at the Qs, the 3 to 7 year bonds. The previous chart was the S&P, the 3 to 7 year bonds, and that's holding up better. Even though it's showing some weakness, this is showing even more weakness currently. And then S&P to world stocks, not doing all that well. We hit the beginning of 2026 and they've been really underperforming. Even as the S&P has been, oh, this was the beginning of 2025. Sorry. What I'm focusing on now is this later drop off that we've been seeing in the latter part of December into the early part of 2026. Now we're also coming up on a more negative seasonal time. We got through the first half of February, and it's nothing great about the first half, but it's darling compared to the second half. Doesn't mean this is what's going to happen. It's just historically going back to 1950, the second part of February tends to be more weak. I go through a lot more seasonal charts in the daily videos and the areas that we're watching. In spite of all the jumping choppy around here, we're just 2.04% away from an all-time high with the S&P. We have a 2% update, which doesn't seem to happen all that much now. We could set a new all-time high here. And so we're not that far away. It feels like it because we've been going nowhere. We go up a little bit, then down, then up a little bit, then down. And so we've been just chopping along here, but we're not that far away. It's not like things are really falling apart. And then this, again, I point this out in other videos too. We were getting far away from the 200-day moving average with the S&P. This is a daily chart. The other charts that I was showing something like this, those were weekly charts. But you see how we've been coming down below this blue dash line? Now that happened at the beginning of 2026. And the reason I keep showing this chart is the signal's already been triggered. We're already watching this. We just don't want to forget about this. This is still lingering in the background. Now it could bounce up and recover. There's been some false signals with this as we were working through October, November, and even into early 2026. But just keeping this in the background, knowing that this is potentially something negative. And we want to keep an eye on volume, but we had the up day on Friday. We were just barely above average. You see the spike on Thursday, and we were going down ferociously. That's a bit of a concern too when we are going down and we see a pickup in volume. I want to keep an eye on jobless claims, even though they fell a little bit after rising here. We're still just within a range right now, and we're ticking back up a little bit, but the blue line, which is a 4 week moving average, is continuing to go down with the continuing claims. Putting it all together, a little bit of a bounce up with the continuing claims in blue, a little bit of a decline with the initial claims in red, and then we had the employment report last week and on Wednesday, and it's like it was way stronger than expected, and the market couldn't go up. And that's a bit of a problem right there. When you get blowout good information or good data, anyway, at least the data that we're given, and the market just can't go up on that, that's a bit of a concern. And so, but we actually ticked down a little bit with the unemployment rate to 4.3%. We're keeping an eye on these ratios, but they're not showing a lot of conviction right now. This is the risk on to risk off ratio, and they've been really choppy lately. High beta to low beta drifting down here in 2026, but the bigger context is that this, for the most part, has been going up. So bigger picture is still positive, but going back to the beginning of the year, we've been seeing underperformance here. We want to keep an eye on utilities. They were weak. We were like, okay, getting close to the 200-day moving average, hanging around the 50, and they just caught a fire here and have really been showing some strength. Now, there's two ways to look at utilities. Historically, they've been considered a defensive part of the market. Widows and orphans buy utility stocks. They tend to pay really good dividends. Well, now you can make a case that utilities are growth because we need AI electricity, we need EV electricity, a lot of Bitcoin mining that's going on. That needs a lot of electricity. And you could almost say that utilities have become a growth area. But traditionally, they've been considered more of a defensive area. Staples, my God, toilet paper, toothpaste, just fly me to the moon here. And it's like this is really moving up overall. We'll just keep an eye on it for now. And this is actually considered more positive. We were getting a little bit concerned earlier in 2026. We were really going up with the 10-year yield. Now we're really coming down. And you can see the big drop on Thursday and then again on Friday. This was considered to be more of a flight to safety. We just a few days uh, earlier in the week, we were at 4.17%, almost 4.8%, 4.18%. Sorry. And we dropped all the way down to 4.05%. That's a big drop for not many days having gone by. And then here are some different ratios, which are not looking good right now. The top one is discretionary to staples weighted, going down. Equal weighted discretionary to staples, going down. Tech to utilities, going down. Biotech to healthcare, going down, but not showing as much conviction. Hotels to utilities, after it had been doing really well, now we're seeing some weakness here. This is another way of looking at growth to value, and we're not seeing a lot of strength here. And then we look at semiconductors, which aren't breaking out and doing all kinds of crazy good things, but they're not breaking down either. Where the home builders, they like what's going on right now. That's more economically driven. Transports, which set an all-time high a week ago, they're off of those highs now. Retail, which is kind of been going sideways to slightly lower, that's a huge part of the U.S. economy. And then the regional banks have been drifting down, but they've been holding up better than the financial sector. Regional banks would be the smaller banks like Silicon Valley Bank, Republic Bank, New York Community Bank. And if we start seeing problems in the smaller banks, that can lead over and kind of be shadows of what happened back in 2008 when we went through the great financial crisis. Not predicting that. That's why we watch these charts. We let the charts tell us what's going on. We don't reach conclusions without evidence. And to me, the charts are the evidence. Oil, which is still in a downtrend overall, this is mainly geopolitically driven right now because of US Iran stuff that's going on. And we were getting up higher. We actually broke above 65. Now we're falling back down to 62, even though it has been declining in the bigger picture. And we're concerned about this. This has been going sideways, going back to the 20 to right to 2023. And real, I wasn't even showing it in this video. It's like, okay, we're not really getting anything here. But look at how we're breaking out. That means energy is outperforming 7 to 10-year bonds. This could be the market getting more defensive, even though there's a cyclical side to energy as well. There's oil, which had been coming down. Now it's starting to go back up a bit here. And then we look at the energy to S&P ratio had been underperforming. We broke above this red downward sloping trend line. Now we're still above the green one, which is longer term. This could also mean that the market's getting more defensive. And we look at the bottom and we see the correlation between oil and the S&P, and it's pretty strong. The oil to energy ratio is pretty strong to the S&P right now. And then gold, which, it's like, all right, it's outperforming the S&P. Not a surprise there. Momentum stocks are holding up okay. If we do start to decline and we see this ratio going up like we saw last spring, that's positive. Even though we're going through hell at the time, this means that there's some hope that we're going to eventually find a bottom. And we did, and then we came up out of that. Well, we're not really seeing a lot of conviction right now. So we'll just keep an eye on this one. And then this shows how US stocks, SPY, that's the ETF for the S&P 500, and how they're continuing to underperform world stocks. And we're seeing US stocks really underperforming international stocks. Now, this one's a bit of a mystery here because emerging markets are getting to all-time highs, and the charts that I look at and I show in some of the other videos, they're doing great. But when we do a ratio to emerging markets to developed markets, which would be the US and Europe's kind of just floundering around right now too. So it's a bit of a surprise where we're seeing this going down. And you would think with emerging markets holding up better, and a lot of money's going into that area right now, you would think this ratio would be going up, but it's not. And we look at the correlation between Bitcoin, which is just falling off a cliff here, the red line, and then we're seeing some weakness in the NASDAQ 100, and the correlation between the two is still fairly strong. This is what I watch over the weekend because everything else is closed, but Bitcoin is still trading. I keep an eye on Bitcoin. It doesn't always line up, but it just kind of gives me an idea. If Bitcoin is up, that might mean more positive things for the NASDAQ 100. If Bitcoin is down, that might mean more negative things. And then the dollar daily chart in a downtrend here, and that's really been helping stocks. Stocks like a weaker dollar. If we see some strength in the dollar, that might pressure stocks. And then here's a weekly chart, also in a downtrend. Actually, we were in an uptrend, but now we're just seeing a death cross here. If we see some more strength here, that could end up pressuring stocks as well. It's great if you're traveling. It sucks if you're a stock holder. And then here are the pivot points for Tuesday's session, which I post on the YouTube community tab. And then I have a newsletter that I put out called the Trade Ideas newsletter. These are just suggestions for things to look at for any particular day. You only get access to that by going to the full-blown website, which currently right now is still free. And then I include that as a PDF in that particular newsletter. And then we have this great thing called the Hindenburg Omen, which the perma bears love, and that's why I avoided it for years and years, because perma bears are wrong 70% of the time. So why am I going to even listen to them? Well, this one, it shows the criteria. And what's happening is you get the initial signal, and the perma bears are like declaring it as a real deal right now. Where if you stick to the rules, there's criteria that has to be met here. And then once it's triggered, then there has to be confirmation. And you can see here, we generated one back in 2025 and then saw some spikes. So it was confirmed, but it didn't really lead to anything here. Well, we had the initial spike on January 29th, and now we've seen some additional spikes here. So this will stay on the books, and this is negative. You can see this chart's been around a while now. We were seeing a lot of these signals before the COVID crash. We were seeing a lot of these signals at the end of 2021 when then we went into the bear market of 2022. We don't know how things are going to play out here. It was negative back in late 2025. Not much happened. And we could see more spikes along the way here and before it finally gives us some kind of a signal. But it was originally March 5th when we got the confirmation. Well, we got another spike on Thursday. And so we bumped that out. It's for 20 trading days, or you could call it 30 calendar days. So that's now been confirmed there. Thank you. I hope you're having a wonderful weekend, and I will talk to you in the next video.